the product we launched was very much a Wizard of Oz project, where there was someone on the back end doing a lot of manual work to get the product to work. So for our first probably 30 binds, we would literally, have an engineer in real time adjusting settings on the back end to basically close out an insurance policy.
Hi everyone, I'm Sunny Recchi and welcome to another episode of Before It Clicked. Today I'm sitting down with Sam Hodges, co-founder and CEO of Vouch, which is an insurance and risk partner built specifically for ambitious high-growth companies. Vouch today has 6,000 companies it supports, with many billions in insured value and well into the tens of millions of dollars in premiums flowing to the platform each year. What I love about this episode is that it's not a move fast, break things story, which is very similar to the other episodes I've published. Because Vouch was built in a heavily regulated, capital-intensive market, Sam and his co-founder Travis spent months analyzing the market, mapping out the insurance value chain, designing a distribution wedge, and choosing how they wanted to approach the problem of solving business insurance for startups. And that's where we start the episode. How Sam and Travis landed on the problem space and how they went from, okay, this is a problem, to designing Vouch and hitting product market fit. Vouch most recently announced a Series D. My last company was a happy Vouch customer. If you're building in a regulated or high stakes space, Vouch is a masterclass in how to execute on that. And if you're building an ambitious company and you want insurance that actually understands how your business works, go to vouch.us and check them out. When I was a customer, it was great. So with that, please enjoy the episode. Sam, good to see you.
Great to see you as well. Thanks for having me on.
Thanks for making the time. Now, you are co-founder and CEO of Vouch, which is a insurance provider for the high growth and innovative companies. You just came off a massive Series D earlier this year. My last company, Tarsal, was a Vouch customer, and we had a delightful experience. And today, I'm really excited for folks to understand how you went from I'm going to start a company to hitting product market fit with Vouch. You had a messy journey to get here, but it was also very intentional. It was very analytical. And I'm excited for prospective founders to hear more about that. To kick us off, though, if you don't mind setting the stage for where Vouch is today, whatever numbers you're able to share, just so folks understand, okay, this is where we are today, before we rewind the clock back to where it all began.
Sure thing. So Travis and I started Vouch with the belief that ambitious entrepreneurial companies needed a better solution for commercial insurance and risk management. So we're now about 7 years into the journey. We've been in market for about 6 of those, and today support over 6,000 ambitious companies all over the country. And so in terms of scale, our team's about 110 people, but many billions of dollars of kind of insured value, so to speak, and well into the tens of millions in premium generated kind of every year through the Vouch platform.
Awesome. Now let's harken back the clock to I think your LinkedIn says September 2018. You started Vouch. You had left your previous company that IPO'd. I'm sure you took some time off. You thought about building something new. Put us next to Sam in those moments when you started thinking about building a new business.
So I've spent pretty much my entire career focused on building and investing in companies at the intersection of tech, financial services, and insurance. I'd spent a bunch of time at the very beginning of my career, actually, interestingly, in the insurance space. First doing strategy work for large P&C health and life insurance carriers. And then I worked at an investment fund in New York where we were very active in what a lot of folks would call kind of wave one of insurtech, kind of back in the early mid 2000s. And so, the first venture deal I was ever involved with was in a company called Duck Creek Technologies, which is now one of the leading providers of policy administration software in the world. So it's nice to say I'd kind of seen inside of certain parts of the insurance ecosystem. I then had a 10-year divergence building a couple of other companies in capital markets tech and then in small business lending. Ultimately, my last company, we were able to take public in 2018. And so coming out of that, spent a lot of time thinking about what problem areas and opportunities were really interesting and exciting. And ultimately, with Travis and with our early backers at Ribbit and at the time Silicon Valley Bank, just got really excited about the idea of using technology to build a much better approach to delivering insurance for small and mid-sized companies. I mean, I think you look across almost any service or financial product category, small and mid-sized companies tend to be less well served than either consumers on the one end or large enterprises on the other. And the reason for that is, dollars are reasonably small, but complexity is reasonably high. And so the only way that you can actually deliver, an appropriate solution at a kind of mass scale for those sorts of businesses is to heavily lean in on the technology side. And for a variety of reasons, most incumbent carriers and brokers and kind of legacy players in the insurance space, that's not something that they would do well or even choose to do in the first place. And so, all along the way of saying, we saw this kind of gaping opportunity in the commercial insurance market specifically, and ultimately that got us really excited about the kind of business we could build. Last thing I'd say, just in terms of my mindset at that point in time, I've been coming off of a journey building another fintech company, and I'd also seen how painful it was to interact with the insurance ecosystem, right? It's slow, extremely paper-based, extremely expensive, very opaque. You want something that can deliver a solution in days or weeks. Oftentimes it takes months, right? And this is, I left Funding Circle, we were spending millions of dollars a year on insurance, and it still felt like a very fragmented, kind of painful experience. And so I think the other point I'd make is, I personally, as an entrepreneur, I like building products and services that speak to pain points I've experienced. And so I think, with this one, Travis and I certainly had that mentality as well. We'd been customers of kind of the legacy way.
Okay. So appreciate that overview. It's super helpful. Day one, maybe you text Travis, you're like, hey, I kind of want to start something new. What does the process look like? Yeah, put us in the room with you. How do you ideate?
Well, so when I started working with Travis, we were very clear that this was the problem and opportunity we wanted to go after, right? So our kind of partnership was founded on like, this is something we want to do. We had backers at Ribbit and at SVB. Travis was working at SVB at the time. I'd worked very closely with Ribbit in the past, who were excited about seeding this idea. And so we were pretty honed in on, okay, we're clear on this is the opportunity, this is the problem we're going to try to solve. What was less clear was how we're going to do that, right? So what were the steps necessary? What do you build first? What's the go-to-market wedge? Those were the design details that we really spent a lot of time on. And so over the summer of 2018, Travis and I spent a lot of time together, frankly. And I do think in kind of the co-founding journey, obviously founders not getting along or founders having very divergent views on how things should go, that's actually one of the leading causes of startup failure. And so I think the first thing Travis and I really wanted to make sure of is we were really excited to work together, and we had a reasonably consistent vision of how this all needed to play out. And so basically through that work kind of came to a view that we're really excited to work together, very complementary. And we had a pretty, kind of common view of like, what would be the big steps you need to take in order to ultimately solve this problem. And
Makes sense.
so by the time we like kind of pulled the trigger, so to speak, and like we're in the business building it, we'd already built out a pretty clear roadmap of what we needed to do. Now, I will say, I think that mentality or that approach is very different from how most startups happen. And I think it was, frankly, due to some of our unique circumstances, also the fact that we kind of were extremely clear on the problem we wanted to go after. But the other piece is, and this is kind of a thing to keep in mind, if you want to build a financial services business, it's actually kind of hard to do that iteratively, right? There are some examples, but usually you need to take a reasonably kind of, in startup speak at least, a reasonably long-term view of where you want to end up, because a lot of the build can take quarters, right? So when we started, we believed that going as an MGA would be the only way to solve the problem we wanted to solve. Well, to build an MGA, you need to line up insurance, paper, so to speak, meaning the actual like insurance balance sheet and capacity behind that. You need to have a regulatory framework that works. You need to have staff on your team who are going to be viewed as credible from a compliance and from a risk capital perspective. And so the kind of minimum viable product, so to speak, building an insurance business is pretty different than if you're building an enterprise software solution or a consumer app. And so I think that the way you approach those early days definitionally has to be a bit different.
This is great. I'm so excited to have this conversation because to date I've interviewed folks who have iterated their way, and you had to take like a much longer time horizon to launching. But preceding that, and I'm very curious how you landed on the MGA approach, but preceding that, uh, you said by the time I partnered with Travis, we knew we were going to tackle this problem space. Did you consider other problem spaces? Because as you know, problem selection is extremely important and it kind of guides everything else. Did you consider other problems prior to this?
No, again, in this one, we came together with the view we wanted to solve this problem. And with, again, folks around the table who were excited to put capital against this thesis.
Got it. So was the inciting factor? You obviously last company IPO. A bunch of VCs, and they're like, "Hey, we observed this problem. Like, would you guys want to work on this?" Like, how did you land on this problem in particular?
Yeah, it's a little bit of a funny thing the way it came together. So, I had been talking to some of the folks at Ribbit for a while about ideas and opportunities. They had actually written a great white paper about opportunities in commercial insurance. That white paper came out in 2014 or 2015. So well before we started the company. I told them that I was planning to leave my prior business. They'd been an investor in the prior business. And they basically asked, like, hey, would you have interest in coming and spending some time with us to think about this? In parallel, SVB saw this problem and Travis was working on it from, his seat at SVB. And so there were a set of people who were kind of like thinking about this problem from a couple different angles. And ultimately they'd said kind of, hey, we want to go do this. And it kind of came together pretty quickly from there.
So, what were the observations? You mentioned Travis experienced this, Ribbit and SVB. What were the observations that led y'all to feel like this was a fruitful problem space to explore?
I think there are a couple things that really drew our attention to this need and opportunity. One was, again, you go through the process of getting insurance or using insurance, right? A claims experience. It's slow, it's paper-based, it's not transparent for the most part. The other piece of it, though, is you think about all the other kind of categories of services one needs to start and then scale a business, right? These areas are ones where you've had digital challengers come in and build really compelling solutions quickly, right? In card, Brex, Mercury, Ramp. In payments processing, Stripe, very obviously. In benefits and payroll, players like JustWorks and Gusto and Rippling. All these companies have kind of come up over the last 10 or 15 years and made it so much easier to build out kind of the finance and HR and kind of financial infrastructure around starting and then scaling a business. No one had solved that problem well for insurance. Insurance was still working the exact same way it had for 40 years, maybe with the addition of email. But if you actually look at the fundamental underlying workflows, the way people were approaching, product creation, underwriting, these things have not changed. And so I think the biggest insight that really stood out for me, and I believe so for the other folks kind of around the table, was if this is a trend that's happening in all other categories, shouldn't it also be something that happens in commercial insurance, where again
Right.
you make it much more integrated, technology forward, and real time, as opposed to fragmented, offline, and slow. And so I think that was the kind of product belief that we all had coming in. The other piece was a belief that you could actually vertically integrate to solve the problem, right? I think it was Keith Raboy who had a great kind of tweet about this, many years ago, which is a great way to start a company or identify an opportunity is take a fragmented, low NPS category and build a vertically integrated solution for attacking that category. I think that is generically good advice. Maybe fewer of those opportunities today than in the past, but certainly, as you think about financial services opportunities, that was a frame that we used as well.
As you began to explore the idea maze here and come up with a solution for this sort of latent problem, sometimes the status quo exists for economic reasons that are hard to identify, and until you start exploring that idea maze, you're like, oh, this is why it's like this is why it's so painful. Um, and how did you think to yourself, is maybe tech hasn't infiltrated this because not because it just hasn't been done, but because it is not profitable to do. Like, how did you think about
Yeah,
this?
I think that's actually it's a great question. So oftentimes the reason a problem has not been solved is because it's not worth solving, right?
Yeah.
To solve the problem would take a lot more cost than the value you can get from solving the problem. So I think the way we address that and the way I, would encourage, entrepreneurs to address it is get really tight on what your expected unit economics are, right? And you have to make some pretty, crisp assumptions around how much is someone going to be willing to pay? And then what are your unit economics as a provider, to that need? Um, Also, frankly, how long and how much capital is it going to take to build that solution in the first place? And unless those things line up, intuitively, unless you can kind of, you know, do a very simple spreadsheet and kind of show to yourself that those unit math can work, you're probably going to have a pretty tough go of it. Now, the good news in insurance, it is extremely clear that people will pay for it, right? This is a existing market where people spend, commercial insurance in the US, $500 billion in spend per year, right? So it is a big market. People spend real money. And it's also very clear how much each particular player spends and how much the products cost, because a lot of these products actually are pretty heavily regulated. And so you can go out into the world and see, how are many existing insurance products rated? And it's pretty easy to do benchmarking on what are the typical prices people pay. And then it just then comes down to, all right, realistically, with a different approach in distribution or technology and or underwriting, how can you drive an improvement in unit economics so that you can actually deliver that solution where the in price is actually well understood? How can you deliver that solution in a way where your unit economics justify the investment to do it? And so for commercial insurance and lending, I think would be somewhat similar to this. You kind of have to believe that you can either hit or beat the loss rates that are prevalent in the space, meaning how much you pay out in claims, but that your acquisition and processing expense is lower. And if you can show that that's true, then you've got a business that works. And so we spent a lot of time thinking about that and then making some early distribution and technology decisions such that we could drive that result.
Okay. So put us in the room with you when you're thinking about that. So at this point, it's just you and Travis. You're batting ideas over with the SVB team, the Ribbit Capital team, and you're like, okay, there's a problem here. We have to see if it's even profitable to solve. What does day one look like? Are you interviewing folks who work at insurers? Like, are you interviewing prospective customers? What does day one look like?
We spent a lot of time talking to customers and doing risk benchmarking and kind of user discovery. We spent a lot of time looking at competitive forums. We did, and this is not good general startup advice. We kind of did some validation that the opportunity was big enough and that we thought that we could get to unit economics that worked, and then we just went for it, right? So brought in a couple people, actually started building. We started talking to insurance and kind of risk capital partners so that we could build the MGA in the early days. But the actual absolute level of validation we did was: is the market big enough? Can the unit economics work? And are there enough validation points that we can pull this together to deliver a unit economic result that works, such that we have confidence we can get this done?
Yeah.
And so once we kind of saw those things, it was all about going for it and really starting the sprint to getting something out into market, knowing
So
of course that would take a good amount of time.
So I understand you and Travis had some insurance experience, but an MGA, just for listeners who aren't familiar, it stands for Managing General Agent, where basically you partner with carriers and help them underwrite the risk, right? They trust you to underwrite the risk of these companies. There is this perennial issue with founders when they're working in a space, they have less direct experience of, do I hire in that experience? Do I learn it myself? Learning it myself slows things down, that I can also iterate faster. How did you think about hiring an expertise versus building it yourself?
So it's a great question, and I think it's a really tricky one, particularly in regulated spaces and/or spaces where you need to persuade incumbent players to play well with you. So to build an MGA or to build an underwriting organization, you need to build an insurance product, meaning that the actual form and coverage features and the rater associated with that. You need to persuade a program carrier or a front to work with you and basically give you the authority such that you can bind policies, using, that which you've built out. And you need to persuade someone to give you the capital necessary to sit behind, the claims. I'm not aware of any MGAs that have gotten going without having someone on the team who is the insurance expert, right? Now, maybe that insurance expert's only been doing it for 10 or 15 years, not 30 years. So I think there's a gradation around how much experience is relevant. But I do think if you want to be in the underwriting and risk acceptance business, you're going to have to pull in at least some folks who have the credibility to be effective in that domain. So knowing that, we made a decision early on that we were going to bring in a few very senior people into the org who were leader doers and who have the credibility to actually build out a respectable approach to underwriting and insurance product development. So two of our very early hires were our chief insurance officer and also our general counsel. Um, General counsel came from more of a tech-enabled insurance distribution background, also some kind of pure play tech. But suffice to say, she'd been in the insurance space, and we thought would be the person who could help us ensure that the overall framework we use in the business was appropriate. Our chief insurance officer, John, came from 20 plus years of building management, professional liability, and financial lines underwriting orgs. And so he had experience across insurance product development, underwriting, actuarial, and claims. And if you want to be, again, an MGA, MGU, those are the disciplines that are really crucial for getting the kind of the insurance guts right. Now, in pretty much every other area of the business, we went with more of the traditional kind of startup profile. So people who either had experience building or who were young and hungry, right? And wanted to come in and work with us to solve the problem and, roll up their sleeves and really kind of really get into it. And I think, frankly, one of the harder things about building, again, in a regulated space or in a capital consumptive space or in a space where you need to persuade, incumbents to play nicely with you, one of the harder pieces is how do you balance those cultures? And so that was something we tried to be very purposeful about, intentional about. Early on, we had a lot of conversations about as well.
I've noticed second time founders, third time founders with successful exits often work in spaces for which they don't have the strongest founder market fit, whereas first time founders fret about this a lot. Um, did you fret like, if I have to hire in an expert, am I the right founder for this? And how did you think about that?
Yeah, it's a great question. I mean, I don't claim to be even now, having been in this business for 7 years, God's gift to insurance product development, underwriting, actuarial, or claims. I think that I know enough about those areas to be dangerous and to call BS on someone who does know what they're talking about as to whether they're any good or not. And so, yeah, I'm sure you could find lots of founders out there who would be smarter and better on the insurancy stuff. But I think I focus on getting sufficiently smart on these domains to be a thought partner to the people on the team doing the work and to know how to interview and hire those people. And again, we kind of made the assumption that we were going to get to some level of success because we had a very well-funded business from the get-go. We had some, major partners involved in the business from the get-go. We kind of assumed that we'd get it from like 0 to 1 if we made good decisions. And so as opposed to, making kind of short-term decisions and then iterating, we tried to go and in certain areas of the business, just build in rebar and concrete from the early days. Now,
Hmm.
did we get that balance perfectly right? No, there definitely are decisions in hindsight that I would do differently now versus the way we approached it. But I do think our general frame of let's assume some degree of success here because we have the resource to make this work. Let's go find great people and let's make sure that we have the right group of skills around the business can be helpful. Last comment with respect to founder market fit. I do think one area where having the right advisors around the business early on can be extremely helpful is actually in supplementing founders in terms of domain expertise and particularly around interviewing the kind of people you need to come in. And
Hmm.
so, if you are a founder trying to build a business that has some complexity to it, right? Maybe you have to be good at distribution, technology, and, some traditional financial services discipline. Well, get advisors in the area where you are weakest as a founder and use those advisors to help you find great people in that domain. That was a technique we used, I think, to pretty strong success for Vouch.
You started off with this problem statement of commercial insurance seems broken for startups. They seem underserved. And you iterated your way to, okay, we're going to be an MGA, i.e., we're going to partner with carriers, help them underwrite the risk. We're going to take on some of the risk ourselves by being reinsurers. How did you go from point A to point B? And do I have the point A characterization correct? Was it really as high level as commercial insurance just seems broken for startups?
High level characterization was commercial insurance is broken for startups. The products aren't designed right and they're not rated or priced the right way or underwritten the right way. And the last point in the early thesis was if you can line up the right distribution partners such that you can meet those clients at the moments that they need insurance, that would be actually a really powerful way of going to market.
Hmm.
That last one is probably the most controversial choice we made as an insurance business, to be clear. Most insurance, I mean, the insurance value chain is like very stolid. You have agents and brokers on the front end. You have wholesalers, MGAs, and carriers in the middle. You have reinsurers on the back end. If you're an MGA, you very rarely are you going to try to go directly to customers. Most MGAs go through brokers, and the job of the broker is to advise clients on risk and to make sure they get into the right products. And so the controversial choice we made early on was we're going to be an MGA, but we're going to go direct to business, leveraging the affinity partners that we were able to kind of get around the company. I think that choice was very consequential for us. It was the right choice. Most MGAs probably shouldn't try to do that in this domain, given some of the needs of the startups we were serving and the fact that there are these points of aggregation. We thought it would be a useful way of going about things, and ultimately it bore fruit.
You made an intentional decision early on, even though Vouch is a YC company, which has a lot of Silicon Valley startups. You actually started off selling to smaller businesses outside of Silicon Valley. Tell me about that decision and how you arrived at it.
Well, to be clear, in the early days, we were always focused on venture-backed startups, but we chose to launch in Utah. And the reason why you had to make a geographic selection on where you launch is, again, these are products that many of which need to be approved at a state level. Utah is kind of a really nice Goldilocks state for what we were doing because it has a very active venture and startup community, right? Was booming then, still booming now. And Utah is a straightforward state to deal with from an insurance regulatory perspective. So they will scrutinize, they will enforce, but it's also well understood what it takes to get a product launched and launched reasonably quickly in that state. Contrast that with California. California, it might take a year to get a filing approved. California is obviously the biggest market for what we do. It's 40%-ish of the total spend in the verticals we serve. But if you have to wait a year for every new product you want to roll out, it's going to be really hard to get to escape velocity. And so we actually did a pretty detailed geographic mapping exercise of what are the states where there's enough activity to justify us investing in a kind of ground game to get the business going, but also where, from a regulatory product approval perspective, we can go and get going sufficiently quickly to start proving this thing out and ultimately, get the momentum we needed to make it a going concern. And so again, Utah was the launch state. I forget exactly what number California was, but it was probably like number 5 or 6 in terms of which the state that we rolled it out.
How did you think about fundraise, team construction before you launched in Utah?
So we knew that we needed a good amount of capital to, in the even first place, build what we wanted to build. And so we did a big standing A. We did a $24.5 million standing A, which we then used to build out the initial team, to build out the technology platform that supports the business, to show sufficient counterparty capital to persuade our fronting carrier and reinsurers to work with us, and also to show some heft for the early distribution partners we had around the business. And so I'm a big fan of the lean startup philosophy. I think to do what we did, that you have to be a fat startup. You have to be overfunded early to have a chance of making it.
Even within, I mean, a $24 million Series A is large, but within insurance, it's a relatively small amount. Were you able to convince insurers to come to the table? Like, how did that work? How did you come across as someone worth trusting?
It's a good question. I mean, to be clear, we talked to a lot of parties, and a lot of them weren't willing to come to the table. So there were plenty of folks who said, "You're too small. You don't have the right team. We don't buy the fundamental theses you have." So there definitely were naysayers. Ultimately, I think the things that allowed us to attract the right partners early on, though, were, again, we had a few people on the team who really knew what they were doing. Enough of us, I think, around the table had some level of seasoning. So we came across as, thoughtful and careful and getting the right balance between growth-oriented, but not going to take the thing completely off the rails. And ultimately, people, I think, bought into this notion that if you can vertically consolidate, build out a bundle of products, and offer those in a very efficient kind of real-time manner to a segment where, frankly, the underwriting results can be solid, that would be a winning proposition. And so, honestly, what I think most people early on were skeptical of, it was actually, could we underwrite properly? And there have been plenty of examples in the insurance space where things go horribly awry because you mess up underwriting. And if you systematically mess up underwriting, you will be dead reasonably quickly because you will either be blowing yourself up or you'll be blowing your partners up. And there's just no way around that. Now, it takes a little bit of time to know whether you're going to blow up. And what's terrifying is I've seen examples in the market of people who think they're doing just fine, but it's pretty clear they're taking on a lot of risks that they don't understand. And then lo and behold, 12, 18, 24 months later, that's when the things come back to nest, so to speak. So honestly, persuading people that we knew what we were doing in insurance product design and underwriting, that was actually probably the biggest hurdle in the first 2-ish years of getting the company off the ground.
Underwriting risk was probably one of the top risks you called out in your Series A deck. What were the other big risks that you raced to de-risk with your initial capital?
Great question. So yeah, definitely getting underwriting right was the biggest one. Getting counterparties involved was the biggest one. And then distribution partner activation was a big one. Like we knew conceptually that there'd be parties like, Y Combinator or SVB, where if you could go into the community and get people really excited about what you're doing, you could find customers to talk to and kind of get them on board. What we didn't know though was how long would it take? And for partners where top-down support would be required, how feasible was that going to be, right? So early on, we really spent a lot of time, in effect, um, positioning the business and doing strong ground game so that we could activate, communities within SVB and communities within YC. A lot of our early client wins were in those two kind of community bases, if you will. But pretty quickly, we needed to start doing it with other partners and other communities as well. And that's honestly where going out and, frankly, prosecuting a great, I call it the ground game, but it's literally like out there talking to people, getting in front of them, hand-to-hand sales goes an awful long way. And I will say, huge credit to Travis. I mean, he was on the hook for a lot of that in the first, 12-ish months of getting the business going. I mean, I think he probably knocked on, several thousand startup doors, metaphorically, just to kind of get the awareness and kind of, again, start driving that activation.
Hmm. You could have sold better, startup underwriting technology to insurers. You said you made a controversial decision to partner with startups directly. Can you talk me through the various ways you wanted to tackle this problem? Like the route you chose, by the way, Vouch, for folks who don't know, that's like the startup's first interfacing with the insurance. When I needed insurance for my last company, I went to Vouch.com, got my insurance from y'all. In the background, you work with other insurers, but you could have taken many approaches to that problem. How did you land on that one in particular? And you mentioned it was a little bit controversial.
So just to kind of pull apart kind of the way insurance business models work. Generally speaking, you're going to be in one of four buckets. You're either going to be a distributor, meaning you are out finding clients, selling to them, managing renewals, and then placing that risk into other markets, right? So taking an insurance policy and placing it with Chubb or Travelers or whomever. Option two, you're an underwriter, right? There are a variety of different underwriting forms you can take, right? You can be a carrier, you can be an MGA, MGU, the form that we started with. You could be, in effect, partner with a carrier and be a very skinny MGA and really just be a white label of what they do. But point being, underwriting would be a second form. Third form, you could be the risk capital, right? Which, frankly, being a reinsurer would not solve this problem. There are plenty of people who do reinsures. And then the fourth is you could try to be a technology provider to someone in that value chain. Being a pure play technology provider, we very quickly ruled out as the approach that would work here. And the reason for that is no existing insurer really was set up to serve this market well. And so you'd have to have like a two-part sell to them if you wanted to start as a tech provider. You'd have to go in and persuade them to use your tech, but also persuade them to resource a new business line pursuing this opportunity, which frankly, if they weren't doing it already, the chances you're going to get the, CEO, CFO's attention and say, this is it, right? Come do this. We thought would be incredibly low. So tech provider ruled out pretty quickly. Reinsurer, similar logic. If you're a reinsurer, you're way at the back end. You can't, as a reinsurer, go and say, hey, MGA, MGU, or carrier, go solve this in-market problem we have. We want to put risk capital against it. It would take probably years, and it'd also just be so foreign for how to do it. Also, by the way, to be a reinsurer, you're probably talking about minimum half a billion in capital tied up to actually have like an appropriately sized reinsurer. So reinsurer quickly ruled out. And so to solve the problem we wanted to solve, which again is great insurance for ambitious companies, there really were only two models: be a broker or be an MGA/MGU. We looked at being a broker. We saw other players being a broker. And the problem with being a broker is that if you do not have access to real-time, properly underwritten, appropriate products that can be delivered via API, you can't deliver a great experience for clients. You're still going to be reliant on pick on your old incumbent insurance company to go and take a file and send it to an underwriter, and the underwriter sniffs the file, and then 2 days later they come back with questions, and then you pose the questions to the client, and that happens ad nauseum until you get a quote, and then the client binds. And that process can take days, weeks, if not months.
Hmm.
So the only way we thought at that time to solve the problem of great experience, efficient, cost-effective approach delivery, and right coverage would be to vertically integrate and do it as an MGA/MGU.
Makes a lot of sense.
And so that's
You
where we started.
Yeah, so that makes a ton of sense. You very intentionally designed Vouch as a wedge into the larger PNC market. I'm curious when that part of the business plan was formed and what decisions you made early on what were decisions you made early on that said, like, look, this is going to place us well for when we want to expand.
Yeah. So taking a step back, we knew that early stage tech startups was an interesting and underserved market. And we thought it was going to be a big enough market to build a mid-sized company. Like you could have a couple hundred million in premium insurance business just doing early stage tech startups. But that means you'd have to have a very high market share. And it also would mean you can probably never be a billion in premium or 5 billion in premium or 100 billion in premium, right? There just isn't enough opportunity there. And so pretty quickly, or really early on, like before we even kind of got into it, we made a decision that we wanted to have the extensibility in our approach to both go up market a little bit, but also to start expanding categories at some point in time. Now, I think the crucial design decisions were really around technology, particularly. And by the way, like we messed a lot of that up. Like some of the technology decisions we made ultimately were too startup oriented. And then we had to go back and kind of refactor things or kind of rebuild functionality so that they would be sufficiently broad. But in general, we tried to think about kind of technical extensibility in terms of what we built. But then the other thing we tried to do was build products, insurance products, I mean. So the forms, the raters, how they're priced and underwritten in a way where you could take those products and offer them to a broader set of clients over time. And so I think it was the combination of those two things that gave us some of the flexibility we've been able to leverage as Vouch has expanded into other spaces.
What made you think
Interestingly,
Sorry, go
sorry,
ahead.
interestingly, so let me finish the thought really quickly. Interestingly, actually, the first expansion was driven by clients themselves because what we saw really quickly, like way faster than I thought, were a number of our clients having breakthrough success and becoming big and much more complicated. And so ultimately what we realized is we had to have a slightly upmarket motion and a slightly upmarket set of products quickly. Otherwise, we're going to turn out some of our best customers. So that ultimately was the first expansion that we got into.
Makes sense. And we do see that business model play out where folks focus on startups grow, and then all of a sudden they're an upmarket player. Um, but what made you think, okay, I can win down market, but the insurers who serve the upmarket are legacy players with billions in revenue. Maybe we will have trouble tackling that market and our growth will stall out once we've won the down market. How did you think about de-risking the upmarket motion?
Great question, and honestly, a risk that we still are facing down. Right, the insurance market is big, but the big players are not dumb. Right, they're very good at what they do. They have legacy challenges, as any legacy players do, but they also have things that they're incredibly good at. So for us, the first thing we thought about was let's just make sure we're not losing our best customers. Let's make sure we build the capabilities internally at Vouch such that when a company goes from being a pre-seed, seed, Series A company to being a Series C company or starting to think about getting a lot bigger, that we can continue to be viewed as a trusted provider of insurance to them. And so the first real kind of business model evolution that we drove was going from being a pure play MGA focused on SME risk within the venture ecosystem to actually having a brokerage capability. what we call Vouch specialty to serve companies as they scaled and also as their product needs got broader, right? Early on as a startup, maybe you only need a BOP and D&O, right, to satisfy a board member's need. Well, a couple years in, you've launched product. Maybe there's a contractual requirement for errors and omission. Maybe there's a contractual requirement for cyber. Oh, maybe you're a business that actually has an online offline hybrid presence. You need workers' comp, right, for the people who are in the place and in your physical space. That goes beyond, the workers' comp you have available through your PEO. And so that kind of complexity and risk and the complexity in products that are needed, that was the first thing we went to try to solve. And ultimately that's actually become a very large share of the business is that motion.
Was there something you did before that Series A raise to try to de-risk that upmarket motion, or did you trust that, hey, if we just grow with the down market companies, we'll be okay?
It was it was mostly the upstream decisions around technology and product extensibility that gave us confidence that we'd be able to retain customers and also expand category over time. And so when we did the company's first two financings, we had not yet expanded up market and we had not yet started expanding horizontally. But we had tried to make decisions that would give us that flexibility so that as part of our pitch, we could credibly say, this is something at some point we want to go and do. This is how you see your way to a big enough TAM such that you as an investor can get excited about this.
You mentioned there were decisions early on in technology that actually made it difficult to expand across verticals and also upmarket. What were those problems?
I think the biggest problem or the biggest set of decisions we made that in hindsight I'd make very differently were overly coupling some of our insurance distribution systems, kind of our agency management and team enablement tools and technology from our core carrier platform. And so beginning about 3 years ago, we made a decision to really pull those apart and have two very discrete parts of our tech stack. A carrier platform on the one hand and kind of digitally native agency management, client interaction, and team enablement set of tools on the other. And so that was again, controversial, expensive decision. It's worked out well for us. It was a big lift to do it. In hindsight, I wish we'd gotten to that realization a bit faster and made different architectural and system decisions early on. And I
Yeah.
mean, look, I think anyone who's built a startup, software driven or enabled startup, almost everyone starts with some version of a monolith. And then at some point you start pulling it apart into a set of connected services. And that's always painful and requires a lot of rework. So I think the key lesson is, where do you accept being a monolith, where at some point, assuming success, you're going to have to go back and, redo things versus, being really principled around, oh no, everything needs to be a service early on.
Sam, Vouch started in 2018, which is, about a decade into tech startups being a hot thing. And I'm using the social network as like the demarcation of when startups became hot. Um, and so what was the why now? Like, it seems to me that someone should have solved this problem for startups already. What was the why now for Vouch?
The why now for Vouch was, I would say, really twofold. One was just the market being sufficiently big to support this kind of opportunity. And you're absolutely right. I mean, I was alive and working, kind of in the immediate aftermath of the bubble crash in the early mid 2000s. There just weren't that many startups relative to now or relative to 1988, 1999. So there was definitely a trough in startup activity for a period of time that definitely did start to pick back up after the great financial crisis. By 2017, 2018, it was pretty clear this is a pretty big opportunity and it wasn't seemingly going to go anywhere. And so part of it again was just, if you look at where growth in the world is coming from, an awful lot of that is coming from technical innovation, and that has to start somewhere. And that's where startups, play. The other realization though was customers were demanding it. And this goes back to, if you use software to do all the other things associated with starting and scaling a company, the service vertical that isn't software stands out like a sore thumb. And so that I think that piece of, well, gosh, again, I'm going to use Carta to manage my cap table and Rippling to manage my, benefits and PEO, and I'm going to accept payments on Stripe, but insurance, I got to call somebody and they're asking me to fax them something. Like it's like mind-blowingly bad on a relative basis. So that was kind of a second part of the why now. Third why now, and this is actually not, this to be clear, this was not true when we started working on Vouch. It has become true over the last 6 years, though, is that a lot of carriers, meaning the actual big, balance sheet, insurance companies kind of sitting behind all this, a lot of them are now offering products via API. And that technology shift is actually a huge development in insurance and is enabling much better experiences on the front end. And so if you are a digitally native insurance distributor, as Vouch is, you have to believe that this enabling trend of API-driven quoted insurance products will be a thing and will continue. And so I do think in insurance specifically, that is driving a lot of now interesting activity on the front end of the insurance value chain.
Is Vouch a classic innovator's dilemma story?
Tell me more. What do you mean?
Like these legacy insurers weren't serving the down market well. Going down market would mean redirecting resources from their most profitable clients, which is like the upmarket clients, and Vouch went in and exploited that. Is that a fair characterization?
I think it's a very fair characterization. The I think there's a very strong innovator's dilemma here, which is if you're running a large insurance company, not only it's hard to redirect resources away from your existing very big, very profitable business lines, but you actually have a set of other problems as well. One of those problems is you are probably reliant on a bunch of third-party distributors who would be extremely annoyed if you tried to build a direct-to-business business. And that, value chain element is a really important aspect of how and why some of the constraints in insurance exist, right? By the way, this is not a new thing. I remember doing strategy work for one of the country's largest property and casualty insurers back in 2006, actually, no, 2004, excuse me. They were struggling with how do we build a digital direct business focused on personal lines opportunities without horribly pissing off our agents. And they
Mm,
spent hundreds of millions of dollars, probably over $1 billion going after that. And it ultimately failed because
mm,
once you have a distribution approach, it's actually really hard to change the distribution approach because you're going to be biting the hand that feeds you while trying to build up your next thing. And so, yes, part of it is the classic innovator's dilemma element of I've got a big business. It's hard for me to redirect resources. But part of it is some of these kind of value chain decisions you make very early on, then do create a lot of downstream dependency.
How much of this did you know before launching Vouch versus discovering it along the way? Because that's really interesting, right? There's two big barriers to legacy people being able to compete with you downstream. One is not pissing off their distributors, and one is just serving the down market in the first place. How much of that were you aware of versus discovered along the way?
That piece of this I was very aware of. I'd
Right.
spent enough time working in and around insurance to know that those were constraints and very real.
Hmm. Do
Lots of
you
other things I
think?
weren't, but
Yeah. Uh, do you think a Sam whose previous company did an IPO could start the kind of business you've started?
I think that a different profile founder would still have a path to building a really interesting insurance business, but I think how they'd approach it would be very different. I think you'd probably either pick an insurance product that you could really build some expertise and specialty in. For example, what a lot of folks have done in cyber, right? Being a great example. Now, a lot of folks are trying to do this in AI insurance, right? Meaning take a technical domain and then think about what is the right risk assessment approach behind it, but go through traditional distribution. So you don't have to try to innovate that as well. Or you'd start by attacking this problem by being an insurance broker. And you'd frankly not try to attack a lot of the product and risk capital complexity that we chose to bite off. And so, again, not to say our decisions were correct or always right, but I do think we had a unique set of circumstances around the business early that made us bold enough and maybe stupid enough to try to do all these things at once. By the way, the other thing to keep in mind, the capital markets for businesses like this were wildly different in 2018, 2019, 2020, 2021 than they are now. And so obviously there are many great capital intensive businesses being built now, but they're different type profile of businesses than the ones investors had the appetite to fund then.
Hmm. Um, Just to give founders a perspective around, okay, this is how much work Travis and Sam did when they were planning out Vouch, and this is how much accountability I should, hold myself to when it comes to analysis. How long did you two spend in trying to wrap your head around the problem, the varying incentives, getting a business plan together, uh, and then executing? Like, how long was that process? And what did the day to day look like? You mentioned talking to a lot of folks, interviewing people. Put us there with
I think
you.
there were probably 4 or 5 months of cumulative person time on research and discovery before basically, we pulled the trigger and said, let's do this.
Hmm.
And then there were definitely more months of, okay, we're doing this. Now we got to figure out how we're doing it and validating a lot of our early assumptions, how we're doing it. That happened over the first 9 months, between when we started working on full time and when we actually launched. So, yeah, I would say cumulatively, probably 7 or 8 months of work on discovery and research of some form.
And where were your theses incorrect?
One of the theses we had early on was buying an insurance company would be the right way to start. We quickly, now when I say quickly, it took us probably 3 or 4 months. Over 3 or 4 months of looking, we realized there were very few assets available that would give us the capabilities we needed at a price point that we could remotely afford. And so that was one where we were kind of overly optimistic on something that proved to be wrong. Um, the other thing, honestly, and this is a very technical point, we made some assumptions around capital ratios, given some of the underlying products that we wanted to write that were wrong early on, to be clear, before we decided to do the MGA path. And so there were certain things that we thought would or could be true that once we kind of waded into the muck, just ended up being wrong. And I think that's this is where it's really hard. Like, how much work do you need to do in order to feel like things are sufficiently validated and battle tested to go? Tricky question, right? Because classic conundrum of even things you believe, the world may not cooperate or the world might change. And so we tried to be thoughtful about what were like true nuclear bombs that would like make this business not work. And we tried to make sure none of those were there. But then a lot of our mid-size assumptions, we just said, look, we're not certain this is going to be true. We're pretty confident. We got to get going. And you change course when things don't play out the way you want them to play out.
Yeah. By the time you launched in Utah, how big is the team?
We were probably 16, 17 people.
60, people. You did your Series A. You said 25 million. Is it immediate PMF? Were there stumbles along the way?
Yeah, I mean, look, the when we launched end of August 2019, we'd just taken the company through YC. We announced our launch on demo day, and then basically our first major milestone is how do we get to 100 customers? And to get to 100 customers, to be clear, the product we launched was very much a Wizard of Oz product rather, where there was someone on the back end doing a lot of manual work to get the product to work. So for our first, I don't even know the exact number, probably 30 binds, we would literally, have an engineer in real time adjusting settings on the back end to basically close out or to bind an insurance policy. Figuring out what we needed to automate versus not, very messy. Took us, it was probably wasn't until 4 months after launch that process worked reliably. Not as in a way that like I was particularly proud of, but at least it worked well enough for us to go and start ramping up sales marketing. And then I think in terms of from that point to, hey, this is working, we've got something going, there's probably another 3 or 4 or 5 months of iterating on our go-to-market tactics before it felt
Hmm.
like, okay, we've got something here. We've got the right balance between the leads that are coming in, the rate at which we're converting them, the way the experience is delivering, the word of mouth virality we're getting. It's one of those like selling to someone you already know is a very different level of market validation versus when someone who you have never interacted with and they're not friends with anyone you're friends with comes and uses your product.
Hmm.
And so that probably didn't happen for us until 9-ish months after launching. When it did, though, that was definitely a major milestone and something we really honed in on. The other weirdness, so again, kind of rewinding in time. So launched end of August 2019. Well, what happened 5 months later? the
Mm.
world shut down, right? We went directly into the maws of COVID. And so that period happened basically right as it felt like we were getting product market fit.
Mm.
We'd raised our B at that point, things were going, and long story short, the world changed. And so we froze hiring. We frankly like really kind of took a big step back and like had a bit of a like, oh my God, like, is this what's happening? Right. I think everyone who was, sentient at that point was having a similar version of it. And we were definitely in a like, oh gosh, could this floor fall out? Concern for 3 or 4 months. And so it wasn't until summer of 2020 when the market crashed and then came back. The venture market started to really accelerate. I honestly say it wasn't until then that we felt like, okay, we're back on course. And then, frankly, fall of 2020, the business accelerated massively. And the reason it accelerated massively were confluence of two things. One, we now, at that point, had had a year of operating activity under our belt. We'd made a lot of iterative decisions around how the thing worked to get it into a better spot. And also, the music was on. There were absolutely tons and tons of companies getting formed and funded. And that was a hell of a time to be in the, picks and shovels business.
It's such an interesting story. I mean, all of the work around how do we do the distribution, um, what are our biggest risks? What is sort of the product that hits PMF? All of that really, it seems like to me, it happened in that first 7, 8 months when it was you and Travis doing a lot of research and talking to folks. And afterward, while there were problems of, okay, the technology isn't ready and therefore we're supplanting it with a human in the background, there weren't like launch and oh shit moments of this, the plan didn't really work, right? It sounds like the plan kind of worked.
From I would say certainly from the fall of 2020 for about 2 years forward, it felt like our plan was pretty dialed in and working. And then it was more about how quickly can we scale and optimize the machine.
What happened 2 years later?
Well, fall of 20, so 2 years after that, it's really more, a little more than 2 years after that, couple things happened. One, the venture market froze up, right?
Mm, mhm.
So going into 2022, pace of company formation, funding fell off a cliff. Also, company failure rates started to go up. And then 5 months after that, Silicon Valley Bank exploded. And so we definitely had a solid 2-ish year window where it felt like we could really push the gas and drive the business. And that's where we grew Vouch incredibly quickly. Beginning in kind of fall of 22, kind of through March of 23, it was more on how do we recalibrate the business to adjust to what was a pretty dramatically different market landscape.
Mm.
So that would be I guess the point of discontinuity.
I love the story because it is a story of two founders who did a ton of work up front, and it saved you guys from having to do the iterative cycle. And granted, you couldn't really do the iterative cycle for a business like this, but um, you made really wise decisions early on that carried yourself through. And yes, you were exposed to exogenous stuff like pandemics and economic downturns, but a lot of those early decisions in early analysis paid off for the next several years. For founders who are in that period or are about to enter it, what lessons can they learn from how you and Travis did your research? What can founders learn from you?
Well, and again, credit also to Ribbit and SVB because they were extremely important in that early work and thinking and kind of evolution of the thesis, right? So part of it is, I think, if you're going to try to attack a big, complex, high barrier to entry market, make sure you've got the right people around the table to actually do that. And I think that goes also to this, question you were asking before about kind of founder market fit. There's founder market, business model fit, and different people are going to have different strengths. Like I would not be the right founder to build a, software infrastructure company, right? Like there are thousands of people who are far better suited to do that. But if a business requires some mix of product and design thinking and operational scaling and regulatory compliance and risk capital, like I'm reasonably good at those things.
Mm.
So I think that's part of it is know what you're good at and then have the right partners around the table to help you understand the things you are not good at. And then in terms of the actual main questions, um, I always think about, what are the waypoints to having a great outcome as a company? And it usually goes something like, can you build a product that people want, right? Using the classic YC adage. Then can you scale that product into a business that is, you know, sufficiently big where you can keep compounding for some period of time and get to unit economics that make sense? And then the third question is, how big ultimately can it be based on either logical extensions to what you're doing or inorganic growth? And I actually think writing down in detail across the main elements of a company what needs to be true to go through each of those inflection points and what can you do upfront to adjust your assumptions around how you're going to go through those stage gates is a really powerful exercise, right? Now, you can't perfectly design experiments to test all those things out all at day one, right? If you would, you just run a set of experiments and then the path of the business would be preset and it'd all be deterministic. Not the way the world works. But gosh, going through that thought exercise is so powerful in actually gaining the conviction on whether this is a good opportunity, but also how do you want to go about it? And the more clarity you have around how you want to go about it, the more efficient you can be as you go through those different development milestones. So my strong advice for people is write it down, get really clear on it. Um, I think the fact that people raise money and plan businesses purely on slides is really dumb. I think slides have a place, but write some of this down, put it into a Gantt chart, right? Come up with a really detailed integrated plan that goes across product engineering and operations and your go-to-market approach and capital. And not to say all of those things have to be perfectly ticked and tied, but at least understanding the way they are going to have to work together to pull the business up. I just think it's very clarifying.
Just so founders can build the right advisory team around them, how concretely did SVB and Rivet help you in those early days?
Well, SVB was instrumental because they were a major distribution channel for us. And so they were an investor in the business. They were on the board. They helped us validate, what we were trying to do. And then they also made a huge number of client introductions. Ribbit offered a tremendous amount of expertise in the insurance space. They helped us actually connect with a couple of the early insurance partners that we had in the business. And they and SVB jointly put a lot of the equity capital in the business to get the thing going. So they were helpful in lots of ways.
Sam, you just raised a big Series B in February, acquired SmartSure. What's next for you? What's next for Vouch?
Sure. Well, so yeah, we did a new financing now about a year ago, and then the other big news from us more recently was we actually ended up selling off the underwriting part of our business to Hiscox. And so the biggest evolution we've seen as a company actually is one we just went through a number of months ago. Go back to kind of our early story. We started Vouch as a direct to business MGA. We then built out a brokerage business so that we could serve clients as they got bigger and more complex. We then actually launched an insurance company about 5 years ago. So we had the Voucher Insurance Company. And long story short, we got to a place where the needs of those two businesses, the underwriting insurance company side on the one hand, and the tech-enabled insurance distribution business on the other, those parts of the business were kind of growing apart. And so long story short, we had a set of conversations earlier this year with a number of potential counterparties, and we're excited in August to announce that we sold the MGA carrier part of our company to Hiscox, and now have entered into a long-term distribution partnership with them. And so, actually, interestingly, probably the biggest shift in how we approach the companies has happened just in the last 6 months or so. On the other side of it, Vouch is going to stay focused on what we've been focused on since the get-go, which is providing great insurance and risk management capabilities to serve the needs of, highly ambitious companies. And we think, obviously, what is happening in the AI domain is incredibly interesting. These companies are moving so quickly and have novel risks and, frankly, emerging risk opportunities for novel insurance products. And so we're doing a lot of thinking about how do we cater to that end market. We probably have more AI clients than any other insurance provider at this point, something like 700 or 800 of them. But we're also thinking a lot about how can we use applied AI and LLMs in our own business, right? Where can this be used to replace certain workflows we have? Also, where can we use it to make our people incredibly performing and even more effective than they are today. This idea of an insurance producer wrapped in an Iron Man suit is, I think, a really powerful concept. And we're in a moment where you're actually starting to see that be a real thing.
Hiring aggressively, I imagine.
Hiring quite a bit, and yeah, things that we're focused on: a lot of hiring, a lot of new partner activation, and also this AI enablement theme. Those are kind of one, two, and three.
I hugely appreciate your time. I mean, a lot of my interviews center around, again, the lean startup approach, launching things, getting market feedback, and iterating. This is the first interview I'm having where it's, look, we have to think really deeply about this because this is not the kind of market that we can ship and iterate, ship and iterate. I'm excited for founders who want to tackle regulated industries to learn from your story and say, look, there is a place for this sort of like very thorough analysis early on, getting the right partners involved early on. And that is another path to PMF. It's obviously worked extraordinarily well for you. Vouch is a legendary company. And again, I was a very happy customer. I really appreciate you detailing that journey for us. And yeah, and I hugely appreciate your time.
Yeah. Well, thank you for the time. Thanks for having me on, and really enjoyed the very thoughtful questions and conversation.